Good afternoon, everyone, and good morning to some of you, and welcome to this webinar hosted by NOREXECO. I see that there's still some people joining in, so we will wait a few seconds before we start. Some practical information. We have 3 great speakers with us today. There will be a Q&A session after each speaker. So please feel free to post a question on the Q&A button. And after the webinar, we will distribute all the presentation. I hope that the video and audio is okay. If not, please post the chat and we can see if we can do anything about it from our end. And with that, I think we should get started. First, let me introduce myself. My name is Anita Schong. I'm the Chief Market Officer at NOREXECO, and I will be co-hosting this webinar together with our CEO, Stein Ole Larsen.
Thank you, Anita, and welcome to you all from me as well. I'm looking forward to spending this next hour together with you. Setting up this webinar, we have focused on 3 things. First of all, we live in turbulent and definitely uncertain times. As business leaders, I guess we all need to know what is going on around us. To help us see that, we have with us David Forten today. David is Vice President of Fiber Economic Analysis at Fastmarkets RISI. His insights and exciting speeches are always valuable to everyone that has listened to him. Secondly, when times are turbulent and there are uncertainties, we need to take measures. We need to take the right measures, meaning we need to manage the risks that are involved. To help us with that, we have together with us today, we have David Model-Flix. David has wide experience in commodity risk management, among that 10 years with Mondelez. He also has experience as a trader. It will be exciting listening to what David has to say today. Third and last, but not least, that was what I was going to say. When you look at the pulp and paper industry from the outside and in, what do you see? What do you see as an investor? Are we attractive, and how do we handle challenges? Also from an ESG perspective. To help us illuminating on this, we have with us Thomas Benedix. Thomas is a Senior Portfolio Manager Commodities at Union Investment. I'm looking forward to your interesting perspectives, Thomas. Okay, let's get started. I pass the word over to David Forten then. Good luck with your speech, David, and I hope you're going to use that guitar in the background.
Not sure anybody would really want that once I started, but thank you very much for the introduction. I hope you can hear me okay. If you could give me a thumbs up from the NOREXECO side, fantastic. Okay, so in the next 15 minutes or so, because I'd like to leave some time for questions, I'm going to try to give you a tour of what we see happening in the global pulp and fiber markets and how things may develop, hopefully leave a few minutes for questions at the end. If we move to the next slide here, the pulp market really, I think, is an interesting market to cover in any time, but especially today, where it's really a microcosm of all of the key themes that we're looking at today, coming out of the pandemic, trying to sort out how consumer behavior has changed in the general sense. And the pulp market has really been forced to sort of traverse all of these major cross currents experienced through the pandemic. Both directly and indirectly through the varied end use markets, whether that be commodity products or straight to consumer goods, and its international exposure. So to start, I kind of wanted to set the stage for the topics we'll be talking about and talk about where we've been and where we might head. So if we start on the demand side, we believe at Fastmarkets RISI, the worst of the economic impact from the pandemic is indeed behind us, and the recovery does continue from pandemic lows. But of course, there are still some cross currents still there, but they have settled lower. So tissue demand, which was on fire last year, has certainly settled lower this year as there's pantry destocking. However, we see the printing and writing segment seems to be turning a corner after a substantial decline last year, and anything related to packaging, e-commerce, consumer goods has just been exceptionally robust. Meanwhile, on the supply side, as the demand for pulp has come back pretty strongly, we've had multiple supply side disruptions that came from extended outages. We had outages at mills due to COVID-related mitigation measures. And then add on top of this, of course, the global logistics issues, where we have a backlog in global supply chains that has really ended up in freight rates just spiraling higher, and delayed deliveries added uncertainty to the market. When we think of the near term, it's important to think about inventories. And inventories, as far as we see them, are a bit mixed and sometimes hard to read, especially on the consumer side. For sure, we've seen producer inventories start to tick higher. I'll talk about that in a slide a bit later. But consumer inventories of pulp specifically might be a bit on the lower end today, which could have implications moving forward if and when demand does eventually seasonally improve. And then finally, we'll talk a bit about the surge in commodities, which has become overall commodities here, which have become much more pertinent to pulp in general, especially now with an active futures market on the Shanghai Exchange, where we had some speculative demand push in pulp prices over the last year. If we move to the next slide, please. So our macroeconomic backdrop, hopefully I will not spend more than 30 seconds here, but the idea here is to give you a picture of what we see moving forward, which in short is a robust recovery. The US is on a very strong recovery path, and the US is a strong engine of growth for the global economy, together with China. China's definitely hit some speed bumps more recently, but it still is on track for a very strong growth this year. We do expect growth next year to slow in China as we kind of come off of the heady levels. But growth in the US should remain relatively robust, and even growth in Europe by European standards at 3% is exceptionally strong. And we see this as the consumer kind of is very excited to kind of get back to consuming, which is what they do best. So overall, we see world growth in GDP of nearly 6% this year, slowing a bit next year to 5%. But we do think the next couple of years present a pretty strong macroeconomic backdrop. So if we move to the next slide, here in a real high level overview of what this means for the major end products for pulp and fiber demand is what happens with paper and board production globally. After an exceptionally difficult and challenging year last year for almost all sectors, but specific to our industry here in paper and board, we saw the change in world paper and board production. We saw that decline last year, almost 15 million tons. This is about a 410 million ton market, and this decline was exceptional and almost unprecedented. If you go back to 2009, it was a bit stronger. But what's interesting this time around is almost all of that decline in 2020 was, of course, in printing and writing papers, as many offices and schools and retail segments were closed. At the same time, we had strong growth in tissue, but it wasn't enough to offset the strong decline in graphic papers. As we move forward into 21 and 22, we are anticipating a pretty strong snapback in overall production. This isn't because printing and writing suddenly roars back to life, but it simply stops falling. And as it stops falling, that allows the growth in the packaging segment and in tissue, as tissue finally gets over this inventory destocking issue, to really pull paper and board production higher over the next couple of years, which means there'll be increased growth and demand for fiber. If we move to the next slide, please. So in the more near term on demand, the industry is shifting to this new normal. We need to understand what this new normal looks like and kind of get over these major cross currents that the industry faced last year and into the beginning of this year. So these two donut charts represent global market pulp demand split out by region on the left and by major end use market on the right. The key storyline for the regional demand side is China is by far the largest market for market pulp globally at nearly 40%. And last year, it was China that was kind of the bastion of growth while the US collapsed and so did Europe. This year, we've seen China remain on a pretty steady growth trend up till now. There are some challenges moving forward. We'll get to that in a moment. However, the US and Western Europe, the worst is behind them. We've been on a pretty strong growth trend there since late in the third quarter of last year, and that continues. So that cross current is settled lower regionally. As we look at the major end use markets with tissue over 40% of total demand, tissue just had an exceptional year last year. We had panic buying and hoarding, increased consumer usage, which is very positive for virgin pulp demand, as consumer tissue products tend to be a higher quality, use more virgin fiber. Meanwhile, graphic papers, which made up last year about 24% of total demand for pulp, just absolutely fell off of a cliff. But that red section of the bar there at about 30%, carton board, specialties, and all other, actually had a pretty strong end of the year last year, due in part to the growth in e-commerce, also in consumers getting back to the market, and strong growth in pharmaceuticals and just overall consumption. Now, as we look forward, we're anticipating this chart on the right to continue to shift, with tissue continuing to grow share. Graphic papers continues to decline as the secular decline in graphics sets back in. And carton board and specialties, I think, is a real positive potential here for virgin fiber demand, especially with growing concerns around environmental sustainability and the replacement potentially of single-use plastics. If we move on to the next slide, please. While we are anticipating strong growth in demand over the next couple of years, we are also at the same time at the cusp of the next wave of a major capacity expansion in the pulp industry. What we've seen over the last couple of decades is that most of the major pulp cycles that are not driven by shocks have been supply side driven. And that is because the size of these major pulp mills that have been added to the industry continues to grow. We have another 3 major projects that are in the offing here in Latin America, and we're looking at once you take in the startup curves of these mills, we're looking at Brasso, which has already started in September this month, that could add up to nearly 3 million tons, 2.8 million tons to be exact, of paper grade, or 1.5 million tons of DP starting up. We've got the MAPA project by Arauco planned for late this year, early next, adding another 1.2 million tons. Then we've got UPM, Paso de los Toros, middle of next year, another 2.1 million tons. Now, all of this doesn't come on the day they start. It takes 4 to 6 quarters to get to full capacity. So that's what we've done here, is we've worked in the ramp up curves. By the end of next year, we're looking at almost 4 million tons of additional capacity. So we need to keep that in mind as we think about how the market develops. Now on the next slide. Next slide, please. Thank you. So in the near term, the supply side disruptions are severe. While we do have all of this capacity coming on, near-term supply disruptions have really rattled markets. So here we're looking at a picture on the right that was put up by the New York Times. This is the major container ship sitting outside of the port of Los Angeles. There were 73 cargo vessels sitting outside the port waiting to unload as of September 19th. Typically, there's 1 to 5 of these. So this is just massive. And this just kind of drives home the point, just how backed up the supply chain is. When you add to this what's going on in China with the zero tolerance policy with the virus, there are backups at the major ports there as they've shut the port of Ningbo. That resulted in ships being diverted to Shanghai and elsewhere, and those are backed up. And it just ripples outward and has caused severe supply delays and a massive increase in freight rates. If you look at the Drewry Index for world container ships, it's up almost 5 times from the end of last year, from about $2,800 per 40-foot equivalent unit, all the way up to over $10,000 today. And this adds uncertainty to markets, disrupts trade flows, and makes inventories more difficult to interpret and manage. On the next slide, please. Here we're looking at producer inventories. These are days of supply for hardwood in purple and softwood in blue. Without going into too much detail, just to give you the high-level overview, you'll notice both lines tick higher. They're both above those dotted lines that run through them, showing that both of these are in an oversupplied state today. We think softwood could be oversupplied today on the producer side by maybe 700,000 tons, and hardwood by maybe 400 to 450,000 tons. They're certainly on the rise, but we need to be careful here because this is a lagging indicator. It typically lags by 1 or 2 months. And it's difficult to tell how much of this is demand side driven versus backup in the supply chain. If we move to the next slide, please. There has certainly been quite a strong run up in prices this year, and it really culminates in everything I just ran through over the past 10 to 15 minutes, which is we put the cross currents in demand together, the supply side disruptions, the inventory changes, and add to that the speculative pressure on pulp prices this time around from the advent of a heavily traded futures market in China. So the red line here is the futures softwood price in China, which has rapidly increased from the fourth quarter of last year into the second quarter of this year. We saw prices up nearly $400 or so per ton. As the futures market ramped up as fast as it did, it pulled along with it the spot market, the physical market in China, which is the gray line. There were arbitrage opportunities along the way where financial players could short the futures market, go long on the spot market and lock in their profit. That pulled the resale market up. And then, of course, that had a knock-on effect to net imports and contract prices. However, that speculative demand push, you'll notice, has really come off as you see that red line drop in the second quarter and remain below the net import price. So now that speculative pressure, we think, is off of pulp prices and it's back to supply and demand. Next slide, please. So this rapid uptick in prices really had severe implications for many of the end users of pulp. While pulp prices are negotiated throughout the month, they can change weekly in resale markets and spot markets. Many of the end uses for pulp are negotiated on a quarterly basis at best in some cases. Sometimes it's semi-annual or annual when in tissue, one of the major end use markets for pulp. So all I'm trying to show in this chart is that the purple and gray bars are the increase from October last year to August of this year in pulp against the increase in those end product prices. The takeaway here is that those purple and gray bars are well above the other colored bars, meaning that the end users' margins are getting squeezed and remain squeezed even though pulp prices have started to come off. And that's going to continue to put additional downward pressure on prices in the short term. Next slide, please. And this rapid uptick in prices and subsequent easing has really added a lot of volatility to the market. And as such, it's disrupted typical relationships between prices. So here we're looking at the NBSK premium over hardwood or bleach eucalyptus kraft, BEK. It is typically cycled nicely around the $70 level, which is the difference in cash costs of production. But what happened in late 20 into 21 is that many of these supply side disruptions were heavily focused on softwood. So instead of this, us reaching some sort of limit by end use for the usage of hardwood and then switching back to softwood, there simply weren't able to get the softwood. So that pushed softwood prices continually higher above hardwood, where there was more supply of hardwood, to the point where we get to a record differential here of about 250. Now, moving forward, we think that this NBSK premium is likely to remain exceptionally high for a longer period of time because we do think that softwood is going to remain in tighter supply than hardwood. And also more of these BEK mills coming on in Latin America are exceptionally low cost, driving the overall average trend in prices between the two, or costs between the two, larger, keeping this spread larger for longer. If we move to the next slide, please. It's also disrupted prices between regions. So early on in the run-up in prices, we saw the premium for China prices over net delivered to the US or even Europe really get to very large levels. So if you focus on the gray bars here, anytime that goes negative, that means the China price is above the US price. And that's what happened throughout the run-up in pulp prices. So pulp suppliers were diverting more and more tonnage to China, therefore tightening up the markets in the US and Europe. Now the opposite is true. As prices in China have fallen, that spread has shifted the other way. And eventually we'll see more of that supply diverted back to the US and Europe because China's demand is relatively weak. Prices are coming off, stronger returns in those other markets. The key limiting factor here to how quickly this kind of corrects is going to be the supply side limitations, which will limit the speed at which they can divert those shipments. Next slide, please. So finally, to summarize things, hopefully we have time for a minute or two for questions, but all in all, our base case calls for cyclical demand growth for pulp to carry into next year. What has really disrupted markets this year it's been a little bit on the demand side, but it's more the supply side disruptions and the shipping challenges that we can see now certainly carrying on through the middle of next year and maybe beyond. There are 3 major pulp capacities projects coming on that have already started through the end of next year. And we are probably on the cusp of a supply side driven price cycle, but there are many risks here around the continued trajectory of the pandemic, the timing and magnitude of any seasonal improvement in demand, which could have been knocked off kilter with the latest energy regulations in China, inventory levels and what have you. So I understand that that was a quick overview, but hopefully we have time for a question or two.
Thank you very much, David. Strong and clear as always. Thank you. A couple of questions. I think Anita got one here.
Yeah. How will China's restriction on energy consumption affect the pulp and paper market? It's a question I've been asked frequently as well. So I'm interested in what your take on that.
Sure. It's a fantastic question. And we just had our North American conference and that question came up many times. For me, I certainly think it adds quite a bit of downward pressure to pulp prices in the short term, potentially. I think some of the issues that the industry is facing is we're already at this point where we're back to this underlying fundamental demand. And I think the industry is trying to sort out where that demand is. We have issues really with inventories. And I think that that's really where this kind of comes to a head or shows itself. I think we have relatively balanced to below balanced consumer inventories of pulp in China, but the finished good inventories are on the higher side. Without a seasonal increase in demand for those end products, which we now may be delayed if it was going to come in the fourth quarter, if many of these industrial segments are forced not to operate, they're not going to increase their production. It's going to be, they may work off the inventories, but they're not going to be producing more to then want to buy more pulp. So any potential seasonal improvement in pulp demand could potentially be further delayed. And I've heard estimates that many of these mills that are forced to be shut or take curtailed operations, that could extend through the end of this quarter.
Okay, one last question. What single incident could potentially have the largest impact on prices going forward?
Wow, that's a really good question. I'm going to take that and I'm going to go back to what happened in 2017 and 18. Coming into 2017 and 18, us along with every other analyst out there were saying pulp prices were going to crash, the market's in trouble, producers put on your seatbelts. And then of course, we had the RCP changes in China where they banned recovered paper imports. And you add to that the shock from Oki not getting up and operating. Everybody anticipated that mill coming on. So my take on this is I don't see anything really from the demand side. I think it's going to be the supply side. And if we have any major disruptions to this supply coming on, I think that would be the major factor.
Thank you very much, David. I think we need to move on then from one great David to another great David. David Model Flicks, the word is yours.
Thank you, Stein. It's a pleasure being here. So for the past 20 years, I help companies to protect margins through risk management of commodities. And I do find the packaging or the paper industry is very interesting within that mix. So I will be sharing today a few of my experiences and some of the best practices I have seen over the past couple of decades. So next slides, please, Stein. So this is just a bit about me, and next slide, it's a disclaimer. So I would like to move to next slide again, please. So I tend to look at risk management through different areas or trends. One is M&A, the other one is volatility and supply chain, and the third trend would be sustainability. Today, I will be focusing here on the second trend. I would like to talk a little bit about supply chains, the complexity, and also the volatility on prices that we have seen in the markets. So on the next slide, please. Yeah, so supply chains, and this is not specific to the paper industry, but it is definitely a big factor, a big component to it. One is freight, obviously. We know that because of the value per weight of paper and cartons, freight prices, it's a major driver limiting very much on how far you can ship or produce or print these papers to the final consumers. And the other, it's energy prices, especially here in Europe. We are seeing high energy prices, mainly driven by carbon prices schemes. And again, talking a little bit about the market, whether we are in a commodity super cycle. I do not like to use that word in this occasion. So the official definition of a commodity super cycle, it's a decade long of sustained high prices, and usually it comes through big structural changes that are persistent. So in this case, yes, because of the pandemic and where we are today, and all the shift in consumer preferences, shifting consumption of goods towards of services toward consumption of goods, the rise of e-commerce and so on. We see several disruptions within the freight, and also the energy prices, which is a big component to the production of paper, but also all along the supply chain up to the manufacturers and the end product for the consumers. So I do believe that some of this will stay structurally high for longer time, maybe not a decade, but definitely energy prices in Europe, it's a major ongoing concern for the coming several years, probably. On next slide, please, I would like to talk a bit more about packaging cost, or packaging prices. And it's aside from paper and cartons, it's interesting to look as well at our side categories. So what are plastics doing? And we have seen a rise in prices over the past months as well. And also even aluminum or some of the metals, which have also seen a run up in prices. So in this case, we can see that volatility in prices is high. It's not different from any other commodities. And I mentioned that because through the supply chain of paper and cartons, going from producers of pulp or plantations down to paper mills, printers, and packaging, and downstream, there are many different players which not always are using the hedging instruments or benchmarks in a way that at times it softens the volatility in the prices, but it also introduces a lot of friction between the different players because that lack of price mechanisms or transparency along the supply chain. So in this case, and there are a lot of similarities to other commodities, but also some differences, and some of them, we have a few hedging instruments. For example, here at the NOREXECO Futures Exchange, also some OTC instruments. There are players upstream and downstream that are very interested and using them to the extent they can, but very often in between there are also different players which are reluctant in using those price mechanisms and working more with a cost pass-through type of contracts. I would like to go to the next slide, please. All right. So within that, just a few of the dynamics in the market. We know that prices of commodities tend to react fast to market developments, and we can see just in these charts, while retail prices, downstream prices to react much slower, right? So companies can smoothen the P&Ls or manage the risk by hedging, by pricing. They have different tools at their hands to manage those costs or those pass through, right? So you can cut costs in different ways. You can invest 1 year in one area, other years in others. You can substitute different products or reformulate on all of that. That's some of the levers that you have in the companies, but obviously some of the new trends, and that I would encourage all participants to explore more actively. Some are doing so already. Is that new trends in the indexing? So indexing contracts, hedging these commodities, right? You can risk manage that way. You can risk manage costs moving forward. You can get a better grip on margin management and financial planning because you are not subject to last minute surprises. So, right, and why hedging and why risk managing? Well, it's very simple in my opinion. If you are not cash rich, I think no companies in the supply chain are today cash rich, and if so, they are not making a good use of their cash flows. basically, markets are very volatile and they can remain irrational longer than you can remain solvent. So there it's, the largest proposition for hedging and risk managing actively, the cost from your suppliers, but also to your customers. On next slide, please. Yeah, something tends to go overlooked at food companies, and obviously not just food companies, but any companies where they have a high component of commodity costs into their total costs, right? So there is a large portion. We think about what we find in the supermarkets. There are probably 80%. It's a commodity cost, and those are costs that reacting very fast to market development, and very often you have hedging and risk management tools. And the rest, let's roughly say 20%. These are not hard numbers, but just to get a bit more of a graphical understanding on what we're talking about. It's about that. It's about conversion, supplier margins, transportation, logistics, which for many years it was kind of stable, and also over the past year have become under pressure given the inflationary environment that we have seen. On the next slide, please. So, as for any company, I think it is critical to have a good understanding of at least these 4 elements that drive prices and that drive your risk management and productions in the company. Demand and supply, for sure. Cost, structurally, of course, and also expectations, especially since So on the next slide, please. Yeah. So these are some of the risk management tools that I like using. One, obviously, forecasting. It's important, especially where you have forward curves. It can add a lot of value. But even if that's not the case, there are a lot of tools that you can use. And there is especially one, which is the factor decomposition. It helps to understand what are the main drivers and what is driving at each point in time. It helps to put a color to all of your plans and forecast, and also simulations. I do like simulations in the case that you are running hedging programs, and especially if you are using options for it. On the next slide, please. Right. So another risk management area, obviously, I do believe that the supplier-customer relationship, it's very important. Collaboration needs to be stronger in some cases, especially in my observations within the packaging supply chain. And these are different value drivers that every company can use. One is investments to gain cost visibility. This could be direct investments or partnerships. In many cases, you can decide whether you want to make it in-house, or to buy it, or to outsource it externally. Long-term contracts, of course, that also have to bring on the contract, moving from a transactional agreement, moving towards more detail with the different parameters and so on, in which cases you could also include cost caps and floors, for example, which even if it's on physical products, you tend to find those options and those tools in the financial markets, but obviously there is no reason why you could not be using those within the physical or contractual agreements as well. So a trend that has been rising over the past years as well, it's to be holding a hedging account for customers to help them risk manage, especially for those medium-sized and smaller-sized customers that do not have the cost opportunity to do all that risk management in-house. There is a lot of fear that the larger suppliers or companies can help as well, in a matter of also helping their customers, also helping them to become more efficient, and overall benefiting from that as well, right? So data sharing, that's a new trend that's coming up as well. So, within certain partnerships or JVs or certain agreements, sharing data, making use of that data in order to find efficiencies and to find solutions across players in the supply chain. On the next slide, please. So yeah, this is a bit of a sum up on the second key point that I mentioned on, through supply chains are becoming increasingly complex and commodities very volatile. They have always been, and obviously today that's combined with disruptions in the supply chain. So some of the main message that I could be sharing here today to the different market players along the supply chain is to reassess the type of pricing mechanisms. There is a lot that can be done with and without financial tools. Another is to enable cost predictability. So especially in these times, one could argue that because of the supply chains are heavily disrupted, we are not able to predict over the next few months or really plan. That's quite inaccurate in my opinion. I think you should be able to plan as well, and it could add a lot of value at this point in time. Obviously, it's very difficult to start now if you have not done so before. It adds some complexity and difficulties in building that, because it does take some change management and some way of doing things differently within the company before you reach a level that everyone is aligned, and that you are able to risk manage costs, that you are able to smoothen P&Ls, to have some predictability, and to be able to react faster to any supply chain disruptions. And the third, that it's a key enabler to all of this, it's technology, of course. Data and technology, it's more readily available today. Still, many companies need to go through that transformation in-house and also within the supply chain to make the best out of those tools. So that's a little bit what I wanted to share today. And now I'm ready to take a question or two, if there are any.
Thank you very much, David. We could really feel your experience on the theme, and we have several questions here. Anita.
Yeah, I have one, probably not the easiest one, but so the market has been very volatile the last year. Do you expect this trend to continue post-COVID?
Yes, and I think the question is what is post-COVID, right? So, I think I was very optimistic a year ago that things could be resolved within the year, but now I'm far less optimistic that the COVID situation will resolve. And as long as we do not see a normal operation, transportation, movement of goods and people around the globe, especially looking here at Asia and Latin America, which are much lower on vaccination rates and still having a lot of restrictions, that will continue to be an issue. So, but yes, as soon as we can return to normality, and of course port congestions and COVID screenings and so on, all of that should go back to normal at some point, whether it's in 6 months or whether it's in a year time. Then yes, obviously we should be seeing again freight costs going back to more normal levels. There is a trend here on demand for goods with the rise of e-commerce and so on. That will continue to grow, no doubt. But again, the high prices that we are seeing today in many commodities, it's not only demand driven, it's more supply driven, supply chain disruptions that we are seeing.
Another one, David, hedging volatile raw material costs is very common in other industries. Why do you think raw material hedging in the pulp and paper industry has been somewhat low until now?
Yes, that's a question I've been asking myself for the first years that I've been in the packaging industry. Out of the 20 years I have in commodities, from agro-food to energy, I must say only 3 or 4 years are in packaging, and that's although I see a lot of similarities, I have seen a lot of resistance, especially along the middle section of the supply chain in using financial tools, hedging effectively, right? So, and in a way, yeah, I mean, I could reserve some of my personal opinions, but definitely there is a lot the supply chain can do there. A lot of the players need to lose that feel that being transparent, it's gonna cost them, that it's better to make up the prices and have good relationship with the buyers and the sellers in order to have higher margins. That at the end, even if it's somewhat true, it would mean that these industries, they are benefiting from some monopolistic environment, which I do understand as well, because obviously you cannot ship, or it's not cost effective to ship paper or carton or boxes, empty boxes across the world. But definitely at the end of the day, that also it's costing these players because they cannot effectively risk manage effectively that volatility. So in the markets are volatile, there is not enough to just pass through costs. You need to effectively manage, because you could be, and I think in these times there are a lot of companies that are feeling squeezed between the cost of their inputs and the prices of their outputs. So there is a big mismatch there, and that's where these companies could benefit from using financial tools, but also some contractual tools that I mentioned earlier, which kind of simulate some of the financial tools within the physical contractual agreements. So at the end of the day, there is a big this industry needs to do. Upstream, there is a good use of financial tools. Downstream, there is a big demand for these tools, and it's in between that the end-to-end supply chain, it's not connecting at its best today. And I think today, it's the players that will be moving faster towards that direction will be the players that will be leading in the next future. It is just so much going on in transparency, in data, in information, in tools that it is in my opinion, is not feasible for the players to keep operating as they have done so for the past decades. They need to step ahead.
Thank you very much, David, for your insights on this. I think it was very, very interesting. Okay, we have to move on then, and the next speaker is Thomas Benedicts. Please, Thomas, go ahead.
Thank you.
All right, perfect. Thank you, Stein. I'm really excited to be here today and present to you and to our audience our view of how we view the pulp and paper markets as a commodities investor, as well as, and especially under sustainability criteria. And I think that fits in very well with what David just before me said, how a sustainable supply chain is really a critical factor going forward. Now, on the next slide, you will see that Union Investment, you may have heard of us, but probably you haven't. We are the asset management arm of the German cooperative banks and manage roughly 400 billion euros of assets in total. A tiny proportion of just over a billion is invested in dedicated commodities funds, which still makes us the largest commodities investor in Germany. And we've been together as a team for more than 5 years now, and all of us have had at least 15 years of commodities markets experience. Myself, mostly in the investment management side with commodities, but also I have had an assignment in commodities risk management at a large German consumer medical product company, which uses a lot of pulp and paper. And that's how I got in contact with the industry. We usually have in our portfolios mostly energy and metals commodities, so both from the industrial and precious metals side. But we're now actively looking into broadening our commodities universe into new sectors, especially into those which we consider to be very relevant for a sustainable and decarbonized future. How do we do that? We'll see that on the next slide. And we consider the 3 pillars of sustainable investing in commodities to be most important. 1 is regulation, 2 is engagement, and actually the strongest pillar is a proprietary scoring strategy that we're currently developing. What do I mean by all of this? The regulatory part is that we acknowledge that security of raw materials supply requires really well-functioning markets. If you have disturbed markets, the supply chain will not work properly. And we consider liquid and transparent trading of commodities as essential to the securing the raw material supply in the long run. And because liquid trading in the end reduces volatility of prices for all market participants. And as David, again, Modal-Flick said before, that there's still little risk management going on among the pulp and paper companies, especially not on exchange markets, right? And that's why I'm basically here today, to promote also NOREXECO's cause, because we believe that would help us as investor also tap into that huge market and unlock some of the liquidity that, and unlock some of the market potential in pulp and paper markets. So that's the first thing. The second thing is we as a company speak to lots and lots of producers and consumers of commodities, maybe private companies, but also states on the equities and fixed income side. And we try to promote a more sustainable production or usage of commodities, especially under those ESG criteria, so economic, social, and governance criteria. And we have a large department that actually does that. Not so much ourselves, because we mostly look at commodities as an asset class itself. So what does that proprietary scoring strategy mean? So we try to develop a holistic approach to scoring commodities in the context of ESG criteria. And I'll actually show you how that works on the next slide. So far, our commodities analysis used to be made up mainly from 3 parts. That was fundamental factors, so supply and demand. The second one, market factors, which we consider as more technical price movement type positioning factors, and also structural factors like cost curves, production costs, and things like that. But now we're adding one large bucket to that mix of commodities analysis, and that's actually the economic, social, and governance factors, ESG. What we try to do is assess the entire value chain and come up with this scoring for each commodity under those sustainability criteria. And what we do here is we try to follow like a transformational approach. What does that mean? Usually commodities themselves are not considered as very sustainable, right? Because often you have on the production side some environmental issues, or you hear about social problems, for example, child labor or unsafe labor conditions. And that will usually, from an ESG perspective, make the commodity less attractive. But on the other hand, we certainly need commodities going forward when we want to have a sustainable and decarbonized future. So, for example, again, something like copper will be needed in every electric vehicle going forward. And also, of course, then the pulp and paper markets we consider as more sustainable because pulp can be produced sustainably. So that helps definitely. And also from a usage perspective, it's not just being burnt like energy products. So it finds its way into certain applications, which is always good. And it's also recyclable. And that's also very helpful. So we consider the pulp and paper markets to be, from an ESG or sustainability perspective, as very attractive. And trying to come up with that score along the entire value chain differentiates this approach to many of the investment banking approaches that are out there so far, because they usually only consider the carbon footprint of individual commodities. So what does that mean for our commodities universe? And that's on the next slide. In a commodities portfolio of the future, what we find to be at the core going forward is things like emissions markets and alternative commodities, where we consider the pulp markets to be part of. So that's really going to be at the core. Alongside of that, and we try to kind of grow here from the inside out, is the traditional commodities sectors of energy, industrial metals, and precious metals. And especially the industrial metals have the potential to play a major role in a decarbonized and sustainable future. Not so much the energy side, although we will need, for example, European natural gas as a bridge technology from fossil fuels to renewable energy. And also, some of the precious metals might have a hard time in a sustainable future. For example, gold, doesn't have as much usage as other commodities, except for jewelry or storage of wealth. So what we could consider for gold as a potential future is if we have new contracts, for example, gold that's sourced under the LBMA's responsible sourcing program. And then, of course, there's some commodities that we will probably exclude entirely from portfolios going forward, like coal, uranium, agricultural products. The good thing about this is also that the return characteristics, which are quite important for us as an investor as well, will differ to some extent than previous portfolios, because the drivers of those commodity prices are different in the pulp and paper markets. And as we've heard again from David before, some of the drivers are similar to other commodities, but many of them are very different. So that's definitely helpful going forward too. So just to wrap up really quickly, why do we consider the pulp and paper markets as attractive from an investor perspective? That's on the next slide. So we have a very large market with a lot of untapped liquidity potential, especially on exchange. Pulp and paper is a natural product which can be produced sustainably and is, for example, a good alternative to plastics products. And it's a great advantage that the pulp and paper products can be recycled or are biodegradable. I mentioned the diversification benefits, and in terms of that, pulp and paper has just very different drivers, price drivers than metals and energy. And of course, one thing that I have to mention, this is pretty much the first fund product that we're trying to launch, which has these commodities within it. So we're trying to leverage our large expertise on our end and to come up with this new product and create a unique selling proposition for our new commodities funds. And that's pretty much it. Thank you very much. Do you have any questions?
Great, Thomas. Really interesting. And we have several questions coming up here. Shall you start out, Anita?
Yeah, the first one is, how do you rate virgin fiber produced paper and board versus those made of recycled fiber?
Right. Okay. So that's, you mean the ranking? So it's certainly a plus, you know, if you have recycled materials, that will give you a better sustainability score on the production side, you know, because you need less energy, maybe less, have less environmental or acreage topics, and that's definitely helpful. This might, and we haven't fully come up with the final scores yet. But what we can see already from the metals markets is that especially recycled products here have a much better score on the production side, because sometimes you need 90% less energy to produce them. So that's always helpful. So the tendency would be for recycled products to come up with a better sustainability score than like new virgin products.
Okay, thank you. Another one. Given the recent raw material price volatility, do you think the banks are likely to introduce hedging requirements in loan offerings to the pulp and paper industry?
Ooh, that's a tough one, to be honest. And because I'm on the other side, right? So what we have been hearing is that banks are still, of course, they haven't had a huge risk appetite over the last couple of years in the commodities space, right? So they would probably, introduce stricter policies with the recent volatility going forward. I could imagine so. But then again, and that might be the good thing about more trading on exchange. You have more liquidity potential to basically directly transact with players that might be more willing to take on risk than banks, right? So as like investors as ourselves.
Mm-hmm. Another one, Anita?
I actually have a question for you, because during your presentation, you said that a liquid, transparent market decreases volatility. And me coming from NOREXECO, having this discussion after the launch of Shafi contract, I think that's a very interesting statement. And could you elaborate a little bit on that?
Yeah, I mean, that's something, and I would have to go back and look exactly at which publications I could give you as an example, but there are some academic studies that have shown that markets that have been trading just OTC are actually more volatile than on exchange markets. I think that the studies go back a couple of years, maybe some of them even maybe decades, because the hard part is usually to measure the differences, right? So so you have to really find markets that have traded off exchange and then on exchange and have a good history of prices. But definitely those academic studies have found that the tendency is that for on exchange markets to have lower volatility than off exchange markets.
Thank you.
Thank you very much. Do we have time for one more?
Last one, maybe?
Last one, yes. Go ahead, Anita.
Yeah. Go ahead.
Forgot my glasses. What are the different forms that your investment take? Equities, loans, derivatives, etc.
Right. Now, as a company, we do, of course, equities, also fixed income products. So, but now in my group, it's basically just futures-based or swap-based instruments that directly relate to the commodities prices in the form. So it's basically derivatives.
Thank you, Thomas, and thank you again to David and David. And I also will use the occasion to say thank you to all of you that have attended. If you have any questions to NOREXECO regarding risk management, please contact Anita or contact me. We will do all we can to give you the good answer and the service that you need. Okay, bye-bye.